Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over the at-risk loss limitations. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies and you want to learn more, make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. We go over the key ingredients to passing the CPA exam. And again, it's only 1 hour, it's free, it's something you don't want to miss. Make sure you go check it out. The link will be in the description. Also, just letting you know, in this video, we will only be going over 5 questions, but members of SuperfastCPA will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a SuperfastCPA member. Now with that said, let's dive straight into the questions. Okay, here is the first question. Mia is assessing her financial exposure for her investment in Green Tech Ventures, a limited liability company that specializes in renewable energy projects. She needs to understand how different types of loans she's involved with affect her ability to claim losses under the at-risk rules. Consider the following scenarios. She has a recourse loan, where Mia and 2 other investors sign for a $150,000 loan from the bank. Mia is personally liable for her share of the loan if the venture fails. And there's a non-recourse loan, where Green Tech secures a $200,000 loan from an investment fund secured solely by the company's solar panel assets. Given these scenarios, Mia is trying to determine which of these would impact her ability to claim losses under the at-risk rules. Which of the following statements is correct? Okay, is she going to be able to include both of those in the calculation, only one, or neither? Well, since this is the first question of the video, we probably don't have a very good idea of what a lot of this means, so let's go ahead and dive straight into the answer to start getting an understanding. Okay, and the answer is that she can only include the recourse loan in her at-risk amount because she is personally liable for that share of debt. Okay, so let's learn about this. The correct statement is that only the recourse loan can be included in Mia's at-risk amount. This is because, under the at-risk rules, an investor can only include in their at-risk amount those debts for which they are personally liable. Since Mia is personally liable for her share of the recourse loan, this loan would count towards her at-risk amount. The non-recourse loan, however, does not count because Mia and the other investors do not face personal liability if the loan defaults. The loan is secured by the assets of the company, not by any personal commitment from the investors. Okay, so we learned here that generally it seems like recourse debt, if they're personally liable, is counted in the at-risk amount, and non-recourse debt, because they're not personally liable for it, is not counted in the at-risk amount. So we got some basic information there, so let's go ahead and go to the next question to start building on that knowledge. Okay, here is question 2. Samantha is a partner with a 40% interest in ABC Partnership, which is engaged in developing commercial real estate. During the year, Samantha engaged in several financial transactions to support the partnership. She contributed $50,000 in cash. She donated land that she originally purchased for $100K, but which had a fair market value of $150,000 at the time of contribution, and now the land's adjusted basis to Samantha is $80,000. Samantha personally guaranteed a recourse loan of $200,000 that the partnership took from a bank, and then additionally, ABC Partnership secured a $300,000 non-recourse loan that was backed by the commercial properties owned by the partnership, with no personal guarantee from Samantha. So we need to calculate Samantha's total amount at risk in the partnership for the year. Okay, so we can kind of get an idea of what will probably be included in the at-risk amount from the previous question, but there's parts of this that we still haven't seen before. So if you want, go ahead, pause the video, see if you can figure this out based on what you learned before. And if not, let's go ahead and go straight into the answer. Okay, and the answer is $330,000. So let's learn about this calculation. To calculate the total amount at risk for Samantha in the partnership, consider the investments for which she bears economic risk. So there's the cash contribution. So that's literally just direct money that she put into the partnership. So that is obviously at risk. There's the land contribution, again, something that she directly contributed, so that's also at risk. But when it comes to property that's not cash, it looks like it's the adjusted basis of the donated property. So not the fair market value, not even the cost basis, it's specifically the adjusted basis. So that was $80,000 here. And then she had a recourse loan where she did personally guarantee the loan, and that made her at risk for the whole thing. If it said she personally guaranteed her share, then we would maybe look at her 40% ownership in the partnership and apply that to the recourse loan. But it says that she personally guaranteed the entire loan. So that we're looking at that as 100% liable. So we add that whole amount to her at-risk amount. Now, the non-recourse loan does not add to Samantha's at-risk amount because it does not involve her personal liability and is secured by partnership assets. Therefore, Samantha's total at-risk amount in the partnership is the sum of her cash contribution, the adjusted basis of the land, and her personally guaranteed loan portion. Okay, so we've learned a lot about what is considered at risk. We haven't gotten too much into what that even means. All we've learned so far is what is considered at risk and what isn't. And again, it's usually things that the person is personally liable for, that they've personally guaranteed or they've personally put into the company, not things that are backed by company assets or whatnot. So let's go ahead and go to the next question to learn some more. Okay, here is question 3. Olivia is a partner in a real estate development company, Riverview LLC, holding a 25% stake. During the year, she engaged in several financial activities to support the business. Olivia invested $50,000. She co-signed a $200,000 recourse loan taken by Riverview. To mitigate her personal risk, Olivia purchased a comprehensive personal liability insurance policy that fully covers her financial responsibility should the LLC fail to meet its loan obligations. And then the LLC also secured a $150,000 non-recourse loan, which again is backed by other assets not personally guaranteed by Olivia. So this is not too much more difficult. The wrench that's getting thrown into this question is, what does this personal liability insurance policy mean for her at-risk amount? So if you want, go ahead, pause the video. You can probably figure out everything about it and then maybe take a stab at guessing what the personal liability insurance policy does. And then when you're ready, come back, we'll look at it together. Okay, and the answer is $50,000. Okay, so maybe you got it right, maybe you got it wrong. In this scenario, Olivia's total at-risk amount is affected by her direct investments and the coverage provided by personal liability insurance. So cash investment, obviously, that counts as her at-risk. The recourse loan would have, because it's personally guaranteed by her, but it's not included in the at-risk amount because of the personal liability insurance, which fully covers any financial liability she might face should the LLC default. Now, this is something that I thought was a little bit confusing because technically she's still on the hook. Like she is kind of personally liable, even though she has that insurance. But to simplify it, just think of it as, in the end, is she actually paying the money? No, that liability insurance will cover the problem. So again, this could be confusing if you kind of really think, well, she is still personally guaranteeing the loan, but just think about it as the personal insurance liability kind of negates that being included in the at-risk amount. Therefore, she bears no actual economic risk associated with the loan, and same thing with the non-recourse loan. It doesn't affect her at-risk amount because it's secured by company assets, so only the $50,000 from the cash is actually included in her at-risk amount. Let's go ahead and go to the next question. Okay, here is question 4. Emily is a partner in a boutique design firm, Creative Solutions LLC, where she has a 30% ownership interest. Throughout the year, she made several financial contributions and guarantees, invested $50,000 cash. She personally guaranteed $100,000, but she did have personal liability insurance on that. The LLC took on an additional $80,000 of non-recourse loan, and that's secured by their equipment. And by the year's end, Creative Solutions reported a loss of $300,000. Emily's share of the loss is $90,000. Given her financial contributions and the structure of the firm's debt, how should Emily treat the net losses over her at-risk amount? Okay, so this is the first time where we're actually learning how all of this at-risk that we've been calculating applies to losses if the company has a loss. So pause the video, think about it for a second, maybe even take a guess at what the answer would be, and when you're ready, come back, we'll look at the answer together to learn how that at-risk amount limits the loss or affects the loss. Okay, and the answer is that Emily can only deduct losses up to her at-risk amount of $50,000 this year, and the remaining $40,000 must be carried forward to future years. So first off, we need to calculate the at-risk amount. So her at-risk amount is only the $50,000 cash investment. Although she guaranteed a recourse loan of $100,000, again, that can be a little confusing, the personal liability insurance negates her economic risk for this amount under the at-risk rules. So basically, even though she is at risk for it, it kind of negates that risk for her. Therefore, it does not contribute to her at-risk amount. The non-recourse loan also does not contribute to her at-risk amount because it is secured by the firm's assets and does not involve her personal liability. Given this, Emily's at-risk amount is $50,000, and since her share of the loss is $90,000, exceeds this amount, she can only deduct $50,000 this year. The excess $40,000 becomes a suspended loss that can be carried forward to offset future income from this activity when her at-risk amount increases. Okay, so 4 questions in, after learning all the other rules, we finally see what this at-risk limitation even means. And it means that she can only take a loss up to her at-risk amount, and then the rest of that loss is carried forward to future years. Let's read a little bit more about that. Losses that exceed a taxpayer's at-risk amount are not immediately deductible and are instead carried forward as suspended losses. These suspended losses are preserved indefinitely until the taxpayer either increases their at-risk amount in the activity or generates sufficient income from the same activity in future years. This mechanism ensures that the losses can still be potentially utilized to offset future profits, but only when the taxpayer's economic exposure, or at-risk amount, aligns with the losses being claimed. Okay, so we learned a whole bunch about what goes into the at-risk calculation, but now we know that the whole reason for us learning to do that is when that person has a loss from their company that is given to them because it's a pass-through entity, they can only deduct up to that at-risk amount of the loss, and the rest is suspended until it can be used in future years. All right, let's go ahead and go to the next question. All right, here is question 5. Jordan is an active member of a pass-through entity, Maple Solutions LLC, and has a 40% ownership interest. This year, Maple Solutions has encountered financial challenges, resulting in substantial losses. Jordan made the following financial contributions and engagements during the year. Jordan invested $50,000, personally guaranteed $100,000, and doesn't mention anything about a personal liability insurance there. And then Maple Insurance also secured a $60,000 loan from Crest Bank, which was backed by the LLC's office equipment. Considering Jordan's involvement and financial contributions, how much of Maple Solutions' losses can Jordan claim under the at-risk loss limitation rules if Maple Solutions reports a $300,000 loss for the year? Okay, this is the 5th question in the video. We've learned a lot about how to calculate the at-risk limitation and then also how losses are affected by that limitation. So you should be able to do this. Go ahead, pause the video, do the calculation, and when you're ready, come back and see if you got the right answer. Okay, and his at-risk amount is $150,000. So under the at-risk rules, Jordan can only claim losses up to the amount he is personally at risk. This includes his cash investment and any loans he personally guaranteed. Therefore, his at-risk amount includes his $50,000 cash and the $100,000 guaranteed bank loan because, again, he personally guaranteed it. The loan secured by the equipment doesn't count towards his at-risk amount. So we have $150,000 at risk for Jordan. So depending on how much of the loss is given to him, he can take up to that $150,000 as a deductible loss because that's how much he has at risk. All right, we've learned a ton from just 5 questions. Before we go any further, let's go ahead and do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice things that keep popping up in the questions. These are calculations, concepts, equations, whatever the case may be, things that keep popping up, 3, 4, 5 times throughout the questions. They're obviously important according to your review course, so you write them down and make a note of them so that you can know them for later. Let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. So first off, what is considered at risk? There's cash contributions, there's the adjusted basis of property contributed, not the fair market value, there's the amounts borrowed for the activity if the taxpayer is personally liable, and we'll go over what recourse and non-recourse means in just a second here. And also, we didn't dive super deep into this because it's not one of the biggest topics, but pledged property that isn't used in the at-risk activity, like a personal residence or something like that, would also be at risk. So let's say a partner personally guaranteed some kind of non-recourse loan with their house. They said, hey, if this goes wrong, you can have my personal residence or something crazy like that. That actually also counts as an at-risk amount. But again, we didn't really talk about it very much because it's not something that is super likely to pop up, but I figured I would put it here just so you knew it. And then let's talk about recourse and non-recourse. So again, recourse means that the borrower is personally liable and losses can be claimed up to the at-risk amount. And then non-recourse loans are secured by collateral without personal liability and typically aren't included in at-risk calculations, except for that one unique situation that I just mentioned where, maybe they did secure the non-recourse debt with some kind of personal asset that's not the company's asset. Now, as far as carrying forward the losses, excess losses beyond the at-risk amount are not immediately deductible, but can be carried forward to offset future income or against increased at-risk amounts. And finally, if the taxpayer has recourse debt that they are personally liable for, but they have personal liability insurance that can cover the liability when needed, this won't be included in the at-risk amount. And again, technically they are at risk for it, but that personal liability insurance pretty much negates that, so they're not really at risk anymore. And with that, those are the pillar topics for this video. To finish up, just one more reminder about the free 1-hour webinar training we have on SuperfastCPA.com. Make sure you go check that out. Again, it's 1 hour, and it will save you so much time struggling with your process. Also, if you liked going through these questions, just a reminder that members of SuperfastCPA will have access to the full 10-question video when we post it on the members forum. So again, if you liked this, you can get more of it by becoming a SuperfastCPA member, and you'll be able to get more practice through the additional questions that we do. If you liked the video, make sure to like it and leave a comment. Thank you so much for watching. I hope this helped, and I will see you in the next video.